Hello everyone, and welcome back to Wealthy Chapters. We are here to break down the most impactful books in finance, investing, and wealth building, giving you the insights you need without the fluff. Grab your notepad, because today's read is a great one. Let's get into it. What if I told you that a trader who blew up his account multiple times as a teenager went on to achieve a 1,132,045% return in a single year? And no, that isn't a typo. That's the story of Lucas Froelich, featured in Chapter 4 of Market Wizards, The Next Generation by Jack Schwager and George Coyle. Today, we're diving into how this German trader turned early failure into astronomical success by constantly reinventing his approach. Froelich's journey began at 13, using money from birthday and Christmas gifts to trade currencies and stocks with extreme leverage. He quickly lost everything not once, but 4 or 5 times. He even sold his bicycle to pay off a debt. His early strategy? Chasing volatile stocks with up to 100-to-1 leverage. Unsurprisingly, that was a recipe for disaster. But Froelich didn't give up. He started consuming free trading videos online, spending 10 hours a day learning. He realized he needed rules to stop the bleeding. He set a maximum loss per stock and a daily portfolio loss limit. That was the first critical turn. Once he had risk control, he began to develop an edge. Inspired by traders like Tim Grittani, he focused on small-cap stocks, which offered explosive moves and inefficiencies too small for big institutions. Froelich and a research partner dug into SEC filings, looking for companies with dwindling cash and imminent need to raise capital. These companies often issued secondary offerings with the help of underwriters who would pump the stock using fake or recycled news releases. The stock would gap up pre-market, allowing the underwriters to dump shares at a profit. Froelich's game was to piggyback those underwriters. He'd short the stock after the pump, waiting for a red candle or other weakness, and then ride it down. He used mental stops often based on standard deviations or time, and he pyramided his position as the stock fell. His rule: if he tried to short 3 times in a day without success, he walked away. This discipline allowed him to survive the squeezes and let his winners compound. A textbook example was Son in April 2020, a biotech that gapped up on massive volume but had terrible fundamentals. Froelich analyzed the capital structure, spotted warrants and converts ready to flood the market, and shorted it multiple times for a killer trade. He explains that these opportunities were plentiful during the COVID boom, sometimes 2 or 3 a day in 2020. He'd dig into the financials in about 20 minutes, looking for cash burn rates, convertible debt, and the history of the underwriters involved. This combination of forensic accounting and technical precision turned a teenager with a bicycle into a millionaire trader. But no strategy works forever. By 2020, the small-cap short game was getting crowded, and the market was flooded with stimulus, creating a euphoric bull market. So Froelich adapted again. He switched to a mid-cap breakout strategy. He looked for stocks with market caps between $1 and $5 billion, small enough to move, but big enough for liquidity. The setup required a powerful catalyst, like a blockbuster earnings report, followed by a consolidation period where institutions were accumulating. He'd enter either within the upper part of the consolidation or on the breakout, and then pyramid aggressively as the trend continued. He used stops below consolidations or key moving averages. The goal? Home runs, not singles. A prime example was GrowGeneration, a cannabis stock that soared after a strong earnings report and sector hype. Froelich bought the consolidation, added on pullbacks to the 20-day EMA, and exited as the move went parabolic. He also rode the huge EV stock wave, where catalysts like government policy or product launches would send stocks rocketing. But he knew this strategy only works in the late innings of a bull market. When the music stopped in mid-2021, he stepped away, unlike many who kept trading it and blew up. Today, Froelich has morphed yet again, now using a long-term, value-oriented approach inspired by Soros and Druckenmiller. He identifies out-of-favor sectors where companies are undervalued due to temporary headwinds, and he waits for a catalyst that will change the narrative. He combines fundamental analysis with technical timing. He often waits for the stock to reclaim its 200-day moving average before getting in big. He uses a combination of contrarian thinking and trend following. For example, in 2024, he bought Chinese stocks like Alibaba at multi-year lows, betting that government stimulus would turn things around. He also traded healthcare stocks like Centene, anticipating that political pressure would protect ACA subsidies. Risking about 5 to 10% per trade, he uses stops and pyramiding to maximize upside while keeping losses small. Froelich even considers the Kelly criterion, the mathematical formula for optimal bet sizing, but he only takes half Kelly to keep volatility in check. This intellectual rigor underpins every trade, whether he's shorting a pump and dump or buying a beaten-down giant. He stresses that the biggest mistake traders make is underestimating how long bear markets can last. His 2022 drawdown of 40% taught him to respect the 200-day moving average and the broader market cycle. What can we learn from Froelich's incredible metamorphosis? First, rules and risk management are non-negotiable. He stopped blowing up only when he capped his daily losses. Second, your edge won't last forever, markets evolve, and you must evolve with them. He switched from shorting small caps to buying mid-cap breakouts to long-term value investing, each time thriving because he adapted to the environment. Third, deep research pays off whether it's poring over SEC filings or analyzing historical price patterns. Finally, have the patience to wait for your pitch. He reminds us that trading is a continuous learning process, and the only constant is change. That wraps up our deep dive for today. Thank you for tuning in to Wealthy Chapters. If this chapter helped you look at the markets a little differently, drop a like, share this video with your friends, and hit subscribe to join the community. Stay tuned for more, and I'll see you in the next chapter.